What is up, everybody? This is James with 77 Financial Group. You're listening to 15 Minutes of Finance, where in the next 15 minutes, I bet I can get you excited about investing. Let's do it. All right. We have a good week again. Guys, the good news keeps piling in along with the uncertainty. It's literally being dragged along by your crush. You're like, yeah, sure, we can go out. We can go to prom. Sure, we can go out. Sure. And then every single time you go out on a date and you're not entirely sure if they like you, all right? And you're left with uncertainty. You're like, the date went good, but I'm not sure if they like me. Okay, that's exactly how I feel right now with everything that's going on. To be honest with you, it's still vague, right? There's no clear, concise data for us except for what the news we're hearing, right? The whispers. We've been talking about the whispers for the last couple of weeks. There's tons of whispers, right? China and the U.S. are apparently coming to a deal. That's humongous. Apparently, Palantir. That's where my mind's at, guys. My minds are on the stocks. Pakistan and India are apparently not going to be killing each other anymore. We have all of this news that is in the works of being handled, and we have no concrete data. It's a little terrifying, but that's also exciting because as the market is trending upwards, guys, it's been like 6 weeks. It's only been 6 weeks since the tariff news has dropped, and it's already basically back up where it was. Now, I'm being a little cautious where I'm not going to talk about, we're not where we were, I guess is what I'm saying. We're not back to 6140, which is right around where the S&P 500 was. However, we are very close. We are very, very close. I think we're at, what did it close on Friday here? 59.58. But late Friday afternoon, we did have some very strange, but honestly not inappropriate news from Moody's, who they basically rate companies or entities on their bond rating. So that's effectively how good they are with debt, right? So it's like a credit score for entities. So they moved us from one of the highest ratings, which is AAA, all caps. Let me make sure I look this up before I'm speaking out of my rear, because I'm not the biggest fan of debt instruments unless it's treasuries or munis. Moody's Treasury USA. Maybe I'll just do that. Oops, not treasury. Again, my mind is bond rating. My mind is on the good stuff instead of on the current news. Okay, yeah, so on May 16, 2025, Moody's Ratings downgraded the U.S. government's long-term issuer and senior unsecured ratings at AA1 from AAA. And there's capitals here, which all mean something. So capital A, little a1 from capital A, AA. And changed the outlook to stable from negative. This one-notch downgrade reflects the increase in the government debt and interest payments ratios to levels higher than those of similarly rated sovereigns. Okay, so that's why the stock markets dropped after hours. If you guys are looking at that, the individual equities dropped pretty significantly. However, I don't think that that's anything to be concerned about. It'll probably take another 10, 15 years for that rating to drop again. Ideally, by then, somebody takes the brunt of just hammering away at this debt we have. And ideally, as GDP increases, we're able to allocate certain funds to this debt. And again, a lot of this debt is to ourselves. So via treasuries, treasury bonds, tips, pretty much every debt instrument anybody in the world can buy, but a lot of U.S. citizens buy treasuries, okay? And the U.S. has never defaulted on treasuries ever in the entire existence, even in times of war, even during Great Recession, okay? Or Great Depression. Guys, I want to talk, we got to go over the news, and then I want to talk about how quickly the market rebounded. And I know we're not quite where we were, but we still don't even have concrete news. And the second we have concrete news, the stock market is going to explode. Good news, ideally. Good news. It'll explode if there's good news. So I want to go over the news, and then I really want to want to tell you, I want to go over what some of the best investors have said in the last 6 weeks, because it's actually pretty shocking. Okay, the really big three that I follow: Ray Dalio, Warren Buffett, Peter Lynch, Tom Lee. And I'm going to go over some of their quotes. And I really want you to grasp the difference. That's the first thing, the difference. And then also how unbelievably difficult it is to be in the stock market and be an quote unquote expert. Okay, it is extremely difficult. And I'll tell you, I'll be honest with you, we're a little firm. Comparatively, all the biggest firms, so the last place I worked, we were a boutique investment firm. We had over $1 billion. Think about that. $1 billion in the investment world is boutique. That's crazy. That's crazy to think about. So these guys that we're talking about, they managed billions of dollars, billions upon billions. And if you count the people that they influence, it's trillions. So we'll get into what they have to say and just the unbelievable difficulty, which is why it's very important to have either an advisor or yourself be able to be on top of things and discern. Okay, discernment is one of the most important things in the stock market. You have to be able to discern. Now, that is a learned skill, and some of it is a little bit inherent. Okay, some of it is, you have to be able to trust your gut. And I feel that the best people who are good at evaluating stocks not only like it, but also they've had to make tough choices in their past, like really tough choices. And it's a little bit of EQ more than IQ, because you have to take risks. This job is about taking risks. Now, ideally, if you're managing other people's money, you're taking calculated risks. And you never, this is our rule, and this is me, right? This is James's opinion. And there isn't really any theory behind it except for, well, let me tell you the theory. You should never have more than one equity position above 8% of your net worth. Now, I say that when Palantir has gone up 400, 500%, a lot of people haven't sold, so that is a significant portion of their portfolio now. However, I do have now stop orders on a lot of them. But the reason for that 8% number is that if a majority of your money's in the S&P 500, okay, averages 10.5%, it doesn't really matter what happens to that 8% you have. Okay, you will ultimately, in the long run, make your money back, assuming the world doesn't end, because nothing is better than the 500 largest companies in the world's best economy. Your individual bets are essentially hedged against that. Now, it is, it's 10.5 to 8%, what you're earning, and then your 8% of your portfolio. I also feel that when you make great bets, right? Say you were perfect last year with every bet that we made. Palantir, Tesla, SoundHound, AT&T, ServiceNow, all those companies, you would have maybe 70% more money just based upon the 8% that you had initially invested, which is insane to think about. But you really only need one or two. Okay. And we'll go over that. Okay. I'm going to read the news, but that is a really important key that I want you to think about if you're managing your own investments. 8% to me is a very, very safe amount to have in an individual equity. I think it covers your bases. It gives you good exposure. And if it's a really great company, then you now can just put a stop order on it. And so effectively you have a little bit of a safety net. And I think Bob Brinker says never to have more than 5% in an individual equity. He's a little bit more old school. He was a really big mutual funds guy, which is fine. A lot of people made money, but there's some negatives of mutual funds too, especially if you're high net worth. But okay, let me read the news and then we will go over this. Okay, market news for the week, guys. Stocks closed higher on Friday, pushing major indexes to big weekly gains for the third time in the last 4 weeks. The Dow Jones Industrial Average and S&P 500 rose 0.8 and 0.7% respectively, while the Nasdaq Composite added 0.5% as each of the indexes closed near their highs for the session. Stocks were coming off a mixed performance on Thursday when the S&P 500 closed higher for the fourth consecutive day, while the tech-heavy Nasdaq fell slightly to snap a 6-session winning streak. Investor sentiment got a huge boost at the start of the week when the US and China announced they had decided to slash massive tariffs they had imposed on one another for a period of 90 days while the two countries negotiate a border trade deal. Meantime, several economic indicators released this week have added to the confidence that the U.S. economy remains on sound footing, though concerns remain about the potential impact of tariffs on growth and corporate profits. The Nasdaq gained 7.2% this week as investors' enthusiasm for tech stocks has been rejuvenated alongside a growing appetite for risk. The S&P 500 was up 5.3% for the week, while the Dow tacked on 3.4%. Each of the major indexes turned in their best performance since the week of April 7th, when President Donald Trump's decision to pause so-called reciprocal tariffs on leading trade partners sent stocks soaring after a sell-off in early April. United Health Group, UNH, which we have not talked about, but we definitely will. UNH stock paced the S&P 500's move higher Friday, rising more than 6% after plunging 11% yesterday, following reports of a DOJ criminal investigation into the company's Medicare practices, which is a very good idea that they should jump into it, right? Politics aside of the Luigi Mangione case, Medicare practices, they just don't track stuff with these insurance companies. They just don't. Okay, back at it here. Mega cap tech stocks were mixed on Friday. Tesla climbed 2% to cap off a week in which the EV maker's shares rose 17%. Alphabet advanced about 1%, while Microsoft, Nvidia, and Amazon inched higher. Chip maker Broadcom fell nearly 2%, while Apple and Meta platforms were down slightly. Oh, this is a great one. Among other noteworthy tech sector moves, shares of server maker Supermicro SMCI jumped 5% today, bringing the weekly gain to 44%. Shares of chip designer Advanced Micro Devices, AMD, which had a good week on news of deals and an expanded share buyback program, rose nearly 2%. Applied Materials, AMAT, shares tumbled more than 5% to lead the S&P 500 decliners after the chip equipment manufacturer posted quarterly revenues below Wall Street expectations amid a slump in China sales. Novo Nordisk shares dropped nearly 3%, which, again, we talked about them last year. We liked them. That the CEO of the Danish pharmaceutical company, the maker of blockbuster weight loss drug Ozempic and Wegovy, is stepping down. The yield of the 10-year Treasury note, which affects borrowing costs on all sorts of loans, notably mortgages, was at 4.45% late Friday afternoon, rising from an earlier low of 4.39%. My bad, guys. My reading today. It's too early. As Moody's announced after the stock market closed that it had downgraded the U.S. credit rating. The U.S. dollar index, which measures the performance of the dollar gain against a basket of foreign currencies, was up 0.1% at 100.98. Gold futures were down 0.7%. West Texas immediate futures, essentially oil, rose 1.4% to $62.50 per barrel. Bitcoin was at 103,600 in late afternoon trading Friday, up from an overnight low of 102,700. The digital currency surged above 100,000 last week for the first time since February. Okay, that was a lot of news. SMCI, I want to talk about this real quick because they had a weekly gain of 44%. I remember I was talking about them with my father maybe 2 years ago, and they had a stock split eventually, but they were getting up towards like $600 a share, I think, and we were looking at them at like $80. And I'm like, I don't like it. We're already in Nvidia. Why are we in this? Why do we want to get in this other company? We don't understand. We don't know. And the stock shot up, had a stock split, and then absolutely cratered. I mean, cratered. I think it went into the single digits. Let me look this up because this goes to show just because something is up does not mean that it cannot come down. So let's see. Yeah, so it got all the way up after the stock split to 106, and then $24. Okay, it got down to $24, which is crazy. That is such a drop. But now it's at 46. So if it's from its lows, it's doubled. That's cool, right? I don't like SMCI. They might explode. I just don't like the company. They have accounting issues. All companies have accounting issues, but theirs seem to be very fishy. Okay, and your company doesn't drop. Doesn't drop. What is that? 1, 2, 3, 4, 5 times. Doesn't drop 5 times. That's pretty crazy if you're not doing something immoral. Okay, I did want to talk about these stocks. Okay, listen, Tesla, Hims, CrowdStrike, AT&T, ServiceNow, and Palantir, and SoundHound. But SoundHound, since they lost NVIDIA's investment, they're still a great company. I need to see their earnings report here for Q2 coming up, how they affect it after this whole tariff situation happened, because it wouldn't really affect them, but I need to see more data before I have a solid opinion. But those companies, okay, those were some of our companies that we had invested clients in, that we were invested in, that we liked. Again, not financial advice, just stocks to watch. They absolutely killed it. Okay, and that might never happen again for us. We might never pick a great company ever again. But that's where this discernment comes in, and the study and the time and the intention. Nobody had more than 8% in any of these stocks. Okay, but pretty much everybody absolutely killed it because we had them in these stocks. Now, AT&T is a little different because it's a dividend company, and I don't view them. They're definitely not a growth stock, but they had significant growth these last 2 years, which is just lucky. But the other ones, especially growth companies, I never really have more than 8%. But guys, we were right. Okay, we had a great year. We had a great last 2 years. I don't know if that's going to happen again, right? It's because you don't know anything. 6 weeks ago, people were saying the world's going to end. Okay, and here we are now, and the world's gonna boom. Everything's going great. It's the new golden age of America. Nobody knows what's gonna happen, and they're all lying when they say that when they do, right? So I wanted to go into what some of these experts say. So let's look at Ray Dalio. If you don't know Ray Dalio, he's still one of my favorite investors because he created the All Weather Fund, and he's managed tens of billions of dollars, if not hundreds, over his career. He's older, but these are just some quotes that he said, okay? And this is between April and May. Right now, we're at a decision-making point and very close to a recession. And I'm worried about something worse than a recession if this isn't handled well. He likened the current economic challenges. Oh, sorry, that's not a quote. That was the end of the quote. But this goes on to explain, he likened the current economic challenges to those of the 1930s, citing trade tensions, rising debt, and shifts in global power dynamics as contributing factors. That's a crazy sentiment to have. Let's see. Criticizing the Trump administration tariff policies, Dalio remarked, "It's like throwing rocks into the production system." So he warned that such disruptive measures could lead to a breakdown of the monetary order and exacerbate domestic and international conflicts. Here's another one. Drawing an analogy between the economy and human health, Dalio cautioned, "Debt accumulates like plaque in a financial system. You're in a high risk of this heart attack, essentially. And now what are you going to do about it?" Essentially emphasizing the urgency of addressing the U.S. fiscal deficit, warning that failure to do so could lead to a severe financial crisis. This is my, it's just reiterating the 1930s comment, which is the Great Depression. So if you guys don't know 1930s, Great Depression. It kicked off in 29, I think, and it lasted pretty much the whole decade. It might have even gone into the first or second year of the 1940s. But that's insane to even say that this period of time is like that. Very much like the 1930s, says Dalio. Unbelievable. One of the best investors of all time, and he's talking about doomsday 6 weeks ago, okay? And now look at where we're at. The best investors get it wrong. And there's one thing I would say when you're dealing with these experts is you have to follow the money. Okay, you have to actually see if they're invested or not. And when these people get on CNBC or get these interviews with these articles, they're not, like, my first question, or maybe after I hear their sentiment, is, where's your money right now? What are you invested in? Are you invested in the stock market? How much of it is cash for stock market? And you need to get that sentiment. They could be lying to you, obviously, but if they're invested, then that doesn't matter what they say, right? It's all about your actions. Okay, your words are meant to trick you, but your actions tell you the truth. Okay, words are meant to trick you, but actions tell you the truth. I want to read what Warren Buffett said, because this is great. And then we'll get to my favorite person, Peter Lynch. And currently, because Peter Lynch is kind of retired, Tom Lee is the guy for me. And we'll go over what he said as well. Okay, so this is some of the things Warren Buffett has said. This year's market volatility, it's really nothing. Investors have emotions, but they need to check them at the door. Consumer staples aren't looking as bulletproof as they once were. Valuations are stretched, and the economic environment has changed just a little. Owning utilities was once a safe bet, but with wildfire risks and regulatory uncertainty, we're reevaluating long-held positions. Okay, how about this one? We're operating at a fiscal deficit now that is unstable over a very long period of time. That is something that can't go on forever, though. Buffett has been caught. Oh, that's not a quote. Oh, here we go. So this is them talking about. Sorry, I went quiet there for a second. In light of economic uncertainties, Buffett has been accumulating a significant cash reserve. As of early 2025, Berkshire Hathaway's cash holding have surpassed $300 billion. This strategic movement positions the company to capitalize on potential market downturns. And when asked why he did that, this was his answer. We will make our best deals when the people are most pessimistic. Well, guess who was most pessimistic? Everybody these last 6 weeks. Luckily, at our firm, we did not sell. And if anything, we tried to invest cash over the long term or over the period of time these last 6 weeks, a little bit every couple of weeks to take advantage of it. Okay. And then lastly, I want to go to Peter Lynch. Again, Warren Buffett, the guy just is so good at investing. And now that he's such an elite member of society, I'm sure he gets insider information. I have no doubt about it. So I'm sure he saw that this stuff was going to come. And so they liquidated a lot of their positions to get a cash heavy portfolio so that way they can then take advantage of these moments. Because the second this news happens, actual news, concrete tariff deal information, oh my gosh, guys, I'm telling you, I can't wait. I'm beyond excited for it because it means it's just going to be, it's not just 1 year. That's going to affect the next 10 years. Incredible. That's all I'll say. Okay. I want to read Peter Lynch. Okay. Okay. This is Peter Lynch from this year on stock picking. The person who turns over the most rocks wins the game. You have to know what you own and why you own it. Excellent, excellent quote. That has to do with discernment. Okay, on timing the market. More money has been lost trying to anticipate corrections than in corrections themselves. What a crazy quote, and that is a deep one. You have to think about that. Essentially, that's saying if you just would have stayed, you wouldn't have lost any money. But if you try to time it, you're gonna lose more money, and that is why 95% of retail investors don't make any money in the stock market. And then on diversification, he said, you only need a few big winners to make a portfolio great. And that's the math of investing. And then, okay, first off, Peter Lynch, favorite investor of all time, great author. Go check out his books. He explains things like you're in third grade, and it's almost zero math. He goes into a few ratios, but it's more qualitative for him. And then the quantitative stuff. So that's fundamental. So qualitative data or news. Oh no, it's not news. It's I guess it's data. Anything you collect could be considered data. So it's qualitative data, and then the fundamentals come second for him. So, and the best example of that is the La Quinta story. He thought about La Quinta, or he was told about La Quinta in the 80s or 70s or 80s, and he's like, "Oh, that's interesting. Let me go stay in a La Quinta." And he literally went from La Quinta to La Quinta all over the country just to see if this company was actually, if this hotel company was as good as everybody was saying. And it was. And he put something like $10 million in there, and it exploded. It 10-bagged, right? That's a Peter Lynch term, 10-bagger. Peter Lynch, amazing. A lot of my philosophy comes from him. Now we have Tom Lee. Tom Lee is probably the biggest stock market bull in the industry, and he apologized about 3 weeks ago. He's like, look, I guess this is bigger than I thought it was. This tariff news, I don't really have an assessment. We don't think it's a recession, but we do have to apologize to you because we thought and we were saying this isn't, this is going to kick back up. And he kept saying that pretty much every week. Hey, this is going to turn around. This is pretty much, we think, the bottom. This is the bottom. And then it goes down 1,000 points, or a little bit more than 1,000 points, 1,100 maybe, or 1,200. And he basically said, all right, well, I'm sorry. We were wrong. And now we're back almost at all-time highs. Every loss has pretty much been accounted for. He was right. He was right with everything that he was saying. And again, for what seems like possibly the last time, because you just never know, we were right. The tariff talk is a tool. Okay, no one actually wants tariffs to stay in place. It's the threat of the tariff. And that's why the biggest kid in the lunchroom gets to threaten people. Because if it does happen, it's going to suck for everybody. The big kid might lose the fight, but he's taken down some kids in the cafeteria with him. And that's the point of these tariffs, is that it was meant to be a threat, and a very, very successful one, it looks like. Nobody wants tariffs. We want free trade. And that has been shouted from the rooftops by this administration. They do not want tariffs. They want equal and free trade. They want zero trade friction between countries. That's what they want. And they exist against us. So that is the one thing I will say about making money with the tariff talk. Tariffs aren't good, but they're being put against us. And if they're so bad, then why do we let other countries do it? Again, that's it. That's pretty much it. Once that gets alleviated, officially, the stock market is going to boom. Tom Lee was correct. We love Tom Lee. His firm is where I get pretty much all of my technical and fundamental data if I'm not just looking at a company's direct financial reports. Guys, great week. More to come, ideally, as long as the news keeps staying positive and we get some concrete trade discussions. If you guys were aware this week, we had a Middle East visit by Trump and a whole bunch of very famous CEOs. Elon was there. Zuckerberg was there. The guy from OpenAI, which is ChatGPT. I think Google was there. A whole bunch of people were there. The robotics scene for Tesla and pretty much any advanced technology with the chips, AI, I'm telling you, yes, it very well could be Terminator and the end of the world. But those are trillion-dollar industries. Trillion-dollar industries, and it doesn't take a genius to see it. Okay, but don't remember 8%. If you're going to invest in anything, keep it at 8%. That is absolutely advice, which I don't think the SEC can get mad at me for. 8%, you really cover your tail, especially if your portfolio is mostly in the S&P 500. And again, one thing that we're different than other firms, a 5 out of 10 risk is the S&P 500 for me. That is middle of the road. Whereas most places will tell you that you're a 5 out of 10. It's the most risk you can be in because you're quote unquote in stocks. It's a fallacy. It's not real. I could defend that against anybody. Okay, guys, that is it. Lastly, I do want to just talk about, we are almost at the end of the month. Well, it's the middle of the month. What am I talking about? We are doing free portfolio financial reviews for all of our listeners, for any of our listeners. We're only doing it for this month. And then we'll probably do it at the end of the year too. But we just want you guys to have a quick second opinion. Okay, quick second opinion of what you're doing. Hey, this is what we would do if we were you. This is why we would change. This is why we don't like that specific stock or this specific mutual fund. I'm able to look at a portfolio and have an analysis or an opinion probably within 5 minutes. Okay, in which case, for a lot of people, it's not that quick and not that easy. So we're willing to offer that to our listeners. A free portfolio review for you, free. It's not going to cost you anything. And we're only doing it for this month. We'll maybe do it at the end of the year as well. So if that's of interest to you, please go to our website. There'll probably be something in the description of this episode for you to click on. Take advantage of it. We want to help you. And we're here to be a resource for you guys. Okay, as always, invest early, invest often. We'll see you next week.